Most investors are buying the wrong properties and don't even realizing it. If you're looking to buy to let the way that most people do, you could be setting yourself up for failure. I want to break down the 3 biggest mistakes that I've seen over the last 10 years of building my portfolio that others make. Number 1, they chase what we call Mayfair Properties. These are areas that are predictably safe instead of profitable ones. So what most investors do is they stick to expensive prime locations, and you see them buying some awful investments in central London, and I'm not even going to mention my second point, which I'll get to, but they really impact me because they think low risk equals best choice, but actually they also get incredibly low returns, and they assume that capital growth will happen. Now, the long-term capital growth in London is absolutely amazing overall, until you actually look at the last 10 years and the slowdown and stagnation that is going on. So I won't run through all the numbers, you can do your own research there, but what smart investors do is they look at yield and growth potential, not just what is the most logical location in their heads. So invest in areas with strong rental demand and business growth. So for example, I could buy a £500,000 flat in London, and you could go, yeah, £500,000 flat's going to be better than a 150 grand house in Leeds, right? Well, maybe for some people, but for a majority of people, no. Not if you're trying to maximize your investment. So what one actually makes more money? Well, a £150,000 house in our areas have that average of 7% plus capital growth every single year. Now, does that mean every single year it goes up 7%? It's like, no. If you look at the last couple of years, it might be 4 or 5%. Then the couple of years before that was 10 to 12% in 1 year, and it changes over time. But the long shot of what we're looking to achieve is tripling our investment every 10 years. So let me just make that simple. On a £150,000 house, I'll probably need about £60,000, and that's going to cover the deposit at 25%, stamp duty, any sort of refurbishment on the house, and any fees associated. So around £60,000. So that £60,000 gets in, and within a 10-year period, I can turn that into 180, often over £200,000. Now, don't just think 200k, is that a lot of money? Tripling your investment. So if somebody has $500,000 in their account right now, I can turn it into 1.5. If somebody has 100, I can turn it into 300 in that Leeds property. Now, there's also the rental side of things. So I might rent out a 150 grand property for maybe 750, 800 pounds. Now, is that a lot in rent? I don't know. It depends on your area, right? But I can guarantee you a £500,000 flat, which is 3 and a bit times the cost of this house, and actually a lot more, which I'll get to in a moment, it's not going to rent for 3 and a bit times more. Now, can you find anomalies? Yes, but they're often not in the areas, even within London, that I wouldn't touch. So let's look at that £500,000 flat. Well, surely if a 150 grand house needs 60k, then a 450k house or flat would need 180k, right? And a 500k would just need a bit more. Not really. And the reason for that is the implications that come into it. So first of all, think about stamp duty. So stamp duty on that 150k house is £8,000 thanks to certain governments playing around with stamp duty tax. So you might think a £500,000 house might be around 24, 25,000 by being around 3 times the price of that. But in fact, stamp duty would be £40,000. 40,000, that's another £15,000 in cash, okay, if you think about just around 3 times the amount. So actually, it really isn't as good as you think. On top of that, capital growth is lower. And here's the big one, in central London, where almost everything are flats, it's also a leasehold property, which means you don't actually own the fabric of the building. You only own what's within it, the flat, which means you also pay ground rent and service charge on a monthly or annual basis, impacting the monthly cash flows. So suddenly, a lot of people think they're investing in prime locations, but actually it's not prime investment returns. Number two, they ignore the real numbers. So this is maybe a different type of mistake, but a lot of investors on the other side, they focus on pure cash flow. And it's probably because they're getting sold this dream that you're going to quit your job, buy a couple of buy-to-let properties, and it's fucking bullshit, just so you are clear. They forget about the hidden cost, the voids, the management, the maintenance, mortgage changes. They get excited by discounts, price instead of value. And so the smart investors, what they do is they use something called return on capital employed. It's factoring in the yield, the net returns, and the capital growth based on what they're buying it from. For example, I actually buy a lot of stock now around market value and at market value because they're in great buy-to-let investment areas with capital growth. Give you a prime example. We bought one around 5 years ago now for around 95,000. Now that's 5 years ago, okay? And we are refinancing now, which is getting the new mortgage after a 5-year fixed period. And they go out and they revalue the property. And this is over a 5-year period. It's just come back at just over 150,000. So this £95,000 property has just come back at 150k. And I remember this particular property very well, so it's good timing this, because it only cash flowed, and remember interest rates were lower then than they are now, it only cash flowed £140. So now, if it were today's interest rates, it'd be cash flowing about £80, and it would still be an amazing investment because of the strong capital growth in those areas. And now the people that said that's stupid, I'm not really going to go back to them at all, so they won't be saying anything. But you can imagine, right? People end up focusing, and I've done it, by the way. I've bought in the mining villages of the Northeast in the past, and they are terrible investments, all right? Huge, huge mistake. Focus on the real numbers. And by the way, I'm going to give you a 2B mistake here. Focus on what's real. Please do not invest in off-plan property. Honestly, the amount of conversations that I've had with people recently by getting absolutely screwed for that. Honestly, one of the worst investments that most people make in property is in property that doesn't even exist yet. And it's not all the time. Some of them go great. Some of them are amazing. A lot more than 50% go wrong. That's what I'll tell you for now. Number three, they do it all themselves, or they struggle to do it all themselves. A lot of investors that I've spoken to, they've been like, oh, I've been investing in property for a while. Oh, great. How many have you done? Oh, about 2. I'm just finishing my 3rd. How long have you been investing? 12 years. I'm like, why? And it's because they did it all themselves. They weren't educated properly, so they didn't really know the great deals to look into. So they were hoping they'd buy something, leave it to grow, and then it refinances. But they bought them in the wrong areas because they thought that buying them cheap is going to be a lot better. And they try to find it, buy it, refurb it, manage it, get it through solicitors, get it through finance, get it, like they're actually getting on their hands and knees doing the labor work. Nothing wrong with that, by the way. But as an investor, they're obsessed with saving and penny pinching rather than actually just utilizing that time to find better deals. And it baffles me when the network that's in property is so amazing. They get stuck with slow mortgage brokers, bad refurb team, dodgy tenants. And smart investors just don't do that. Smart investors understand that your net worth is your net worth. They try to tap in and leverage experts to find and manage the best investments, all right? They work with portfolio building services that sort of off-market deals. And yes, I've got a vested interest. I've got a company that does that. And shameless call to action, by the way, if you genuinely want to build your boring vanilla buy-to-let portfolio and you want experts doing everything, and I mean everything for you, you just need to have the funds available. Put a portfolio in the comments right now, and I'll put a link in reply, and you can book in a free one-to-one consultation session. There you go, my little pitch there, but no hard pitch at all. Genuinely, have a call with the team. We can give you a guide on how to do this yourself if you really want to, but ultimately, most smart investors just utilize other people. And by the way, Aspire Portfolio's first ever client is sat right in front of you, and we're still our biggest client. I still pay my company to find me these opportunities because I know they're great and they're looked after. So don't make the common mistakes. Make sure you're putting in the effort to actually get educated on what the numbers really are. And we'll walk you through that on the call, by the way. Understand what makes a great area. Don't buy off plan. Buy something that is one of the biggest benefits for property is it's tangible, it's bricks and mortar, and then people go buy air where something may or may not be in the future. Do things right, network is your net worth, and really go all in the right way. Safe, secure, boring, vanilla buy-to-let properties. I hope this has been valuable. I look forward to having a chat with you on the call, whether it's with me or my team member about building your portfolio. And if you're not subscribed yet and you want to find out more about property, investment and business, make sure to hit the subscribe and the notification bell, and I'll see you in the upcoming video.